Sustainable finance, green finance, climate finance can differ in activity coverage and investment objective. According to Burrow, Desertine, Migliorelli, and the China Council for International Cooperation on Environment and Development 2022, sustainable finance supports sustainable economic activities, including environmental, social, and other sustainable development goals in the investment process. Green finance refers to investments aimed at climate and other environmental goals. Meanwhile, climate finance refers to the financing that is dedicated to supporting climate change mitigation and adaptation actions. Carbon taxation versus emission trading system. A carbon tax and emission trading system are two main carbon pricing policy instruments. In an ideal world, they are efficiently achieving environmental objectives. However, in practice, there are some notable differences between these two policies. The first major advantage of carbon taxation over an ETS, that is the emission trading system, is that price certainty. A carbon tax provides a clear and predictable price path for greenhouse gas emissions. This predictability is crucial for business as they plan long-term investments. Knowing the future cost of GHG emissions allows companies to make informed decisions without the risk of facing volatile prices that could drastically change in a short period. This stability is especially valuable for capital-intensive industries where investment horizons span several years. Another key benefit of carbon tax is its relative simplicity and transparency. Unlike an ETS, which requires complex trading mechanisms, continuous cap setting, allocation mechanisms, and monitoring of trades, a carbon tax is straightforward to implement. It is clearly outlined that costs associated with GHG emissions, making the financial flows easy to track and understand. This transparency simplifies the process for both government and business, reducing administrative burdens and enhancing public trust in the system. Carbon tax can also generate substantial revenue for the government, and this revenue can be used to fund various public services, offset other taxes. While ETS can also generate revenue if permits are actioned, this is not inherently built into the system. In reality, most emissions permits are given to emitters for free. Furthermore, the implementation of a carbon tax through relevant tax authority offers a distinct advantage in lower and middle income economies. By leveraging the existing infrastructure and expertise tax authorities, a carbon tax can be more effectively enforced, ensuring better compliance and outcomes. By contrast, environmental ministries in these economies may lack the necessary capacity and resource to build and regulate an ETS. However, ETS do have several notable advantages over carbon taxation, particularly in terms of emission certainty. However, broadly speaking, these two carbon pricing policies are more similar than they are different, with both approaches sharing the common goal of reducing GHG emissions and mitigating climate change at lower economic cost. Designing and implementation futures probably matter more than carbon taxation versus ETS debate.